Hello, this is Si Wing Yi from the Yi Real Estate Network. I'd like to go over my understanding and my presentation of the housing cycle for 2016 and beyond, and of course, where to make your next investment property purchase. And again, I'm not an economist, and but I play one on TV. No, just kidding. Anyway, as a real estate wealth advisor, consulting with my members of the network as well as any other investors that has been regularly watching my videos and newsletters throughout on a weekly basis about what markets to purchase, I like to take a step back right now and just look at things from a high level. Okay, I have spoken, I have educated you folks about the timing of the purchases with respect to your investment property portfolios. But I like to spend a few minutes on the real estate cycle as you see here on this chart. All right, and then again, I will look at it from a high level, from a conceptual perspective, and then when I recap this presentation, then you as an investor will be even more informed about your own investment strategies and how to use the turnkey approach of investing as I practice over many years. So, without further ado, let's go over this particular chart. We have one, two, three, four, five phases. Phase one is the cycle bottom in early recovery. Cycle two is phase two is the expansion. Phase three is exuberance. Phase four is contraction or early downturn. And phase five is the full downturn recession. As you can see by the color markings, phase five pretty much indicates the like a red flag, if you will. So, and then I don't know, the lighter the color is, the better it is, I think. I don't know. Anyway, so let's begin. I'm going to describe phase to phase and use some practical applications, use my own experiences over the years, because I've gone through a number of real estate cycles in my professional career. So, and of course, I've been uh, have entered many different uh, real estate markets throughout the country and have taken hundreds of my investors to various markets throughout the past several decades. And of course, and I will continue to do so. So without further ado, let's look at phase one. And phase one is pretty much, as we describe here, mainly distressed capital investments, declining to flattish pricing slash volumes. So, from based on the past experience, in terms of a timeline on phase one would be probably at around 2008, 2009, 2010, 2011. That's where the uh, the the recent crash occurred in 2008. Then 2009, you see whole lot of foreclosures all over the country, and the banks start foreclosing on many of the homes. You've been there. It was only about 2009 is only about 7 years ago. So, and many of the what I described as actually trophy markets, if you will, the really very desirable markets, are typically located in the southeast of the U.S. and south, west, and west. That's where the market went up and down. So, and specifically, those markets are really, back in '05, '06, '07, when the housing prices went up tremendously, which is inflated, which is really, really bad for various reasons. That we have the mortgage crisis during that time. Then, of course, 2007, 2008, everything went crashed down in California, in Arizona, specifically in Phoenix, Arizona, and in Las Vegas back in '06, '07, and of course, Florida as well. those so-called trophy markets really crash. So typically, a single-family home back in '05, '06, '07, like 1,100 square foot, three-bedroom, two-bath, in those markets, with exception California, is around went all the way up to $250,000, and people, anyway, and then 2009 it crashed. Those $250,000 cookie cutter homes has crashed all the way down to like $70,000 to $80,000. So therefore, in phase one, in 2009, 2010, 2011, there were so many foreclosures in the market, was selling for pennies on the dollars, right? And so 250K down to 280, 90K, 100K. So many savvy investors, many savvy hedge funds, those Wall Street hedge funds, as a group, they came into many markets in Florida and mainly all the country really, but I want to emphasize the more sort of exciting market, the trophy markets, if you will, Florida and Arizona and Las Vegas and California. So phase one, there was so much opportunity to make money, but a lot of these foreclosures that occurred in phase one, 2009, 2010, distressed sales, and typically a lot of the people that scoop up this kind of REOs, real estate owned properties, that are taken back by the bank from the homeowners and investors that went bankrupt, that went foreclosed on. Anyway, you have to buy a lot of it in cash, right? If you are cash rich, like many foreign investors back in phase one, 2009, 2010, they went to all these kind of great markets and scoop them up, pay pennies on the dollar. So those people, those group of individuals, they make a lot of money back in 2009, 2010, 2010, 2011. So obviously, the REOs, the bank REOs are done, all absorbed, all has been purchased by very savvy, cash-rich investors from all over the world, really, not just from the U.S. So you know who you are. Some of you know exactly what I'm talking about. Some of you who have experience have already pulled the trigger back in phase one, 2009, 2010. So you guys are made out like a bandit, okay? So you should be glad that you did what you did. So now it's over. The foreclosure REO markets are pretty much over, right? So it's done. It's just you have to know how to time the market. But if you did not pull the trigger during phase one, well, you could be, you were sorry. You said should have done, should have, could have, would have, right? But that's how it is. You just, if you procrastinate, if you just delay, then money will bypass you, become extremely wealthy. Uh, Some of these cycle will you're gonna regret it. Okay, now let's go over to phase two. Okay, phase two, which is the expansion cycle, and and highlighted by capital investments picking up, rising sales prices, good affordability, and low construction. All right, and some of these cities are currently in this phase two. So expansion to me are really very significant. This is a time to pull the trigger. For those of you that did not pull the trigger in phase one, well, you have another chance. Okay, you have a second chance to make up for lost time. You have a second chance to redeem yourself, really, right? To become rich if you understand the phase two, how important the timing is it. So therefore, some of the cities in phase two, as you can see here, is some excellent opportunity to buy. But I want you to hold your thought for a moment. I want to go through the analytical stuff. I want to go through the numbers, which I've been teaching you. So before I do that, let's go over to some of the cities that are affected in this phase two recovering cycle, right? Still pretty much at the bottom, but is recovering. We call it expansion phase two, which is in Southern California, San Bernardino, Atlanta, Georgia, Phoenix, Las Vegas, Tampa, Minneapolis, Orlando, Charlotte, Raleigh, DC, LA, and Nashville, Tennessee, and Denver. All right. So as an investor, what should you pull the trigger as a real estate investor, buy single family homes or multi units, duplex, triplexes in this area? Well, I taught you a while back about the 1% rule. The 1% rule is the rent to price ratio. That means is the price of the investment home you're buying. Let's say 150,000 multiplied by 1%, the gross rent should be 1,500. It's a simple calculation. This calculation will make or break you financially, right? So if any investment homes that meets the 1% criteria, in my estimation, you're gonna have a very good return. You're gonna have a very good capitalization rate, which is like, at the 1%, $150,000 property at 1% rule, $1,500 gross rent. $1,500 gross rent. If you put 25% down payment financing, you will typically achieve around $500 monthly net cash flow. That pretty much equal to like 8% capitalization rate. Okay, this is the benchmark as I taught you. And the cash on cash return on a 25% down payment, typically around 12 to 15% cash on cash return. And the total ROI is pretty much like 30%. So this is the numeric benchmark. So as you look at these markets, which one do you think meets the 1% criteria in this phase two? Phase two is right now, right? Phase two is like 2014 to 2016, maybe 2017. All right? Listen to me, okay? Pay attention to what I'm saying. This is very important. I'm giving you technical knowledge and practical knowledge. So, which of these cities meets the 1% ratio? The answer, as far as I know, Tampa and Orlando, Central Florida. Oh, by the way, I am promoting Central Florida for quite a while, all right? Especially for the past 12 to 18 months. Okay, I'm been promoting very heavily. Central Florida is one of the fastest growing region in the country right now, according to various reputable publications, including Forbes magazine and a few other publications. Top 10 in population and job growth. Definitely, if you buy in Central Florida, Orlando Metro, and Tampa Metro, you will meet the 1%, even exceed 1%. Then some of you can ask me, why not buy in Las Vegas or Phoenix? Although Las Vegas and Phoenix, and as well as any other cities listed on this phase two, you're not going to see 1% anymore. You should have bought Las Vegas and Phoenix in California back in 2009, 2010, 2011, between phase one and phase two borderline area. Okay, because if you want to buy a single family home, cookie cutter home in Phoenix, Arizona, or Charlotte or Atlanta, Georgia, whatever, 150,000, you're not going to get 1% because the rent will probably going to be around 1,200. You buy a $150,000 single family home rental investment property, your gross rent will be around 1,200. So that's not 1%. That means your cash flow is very, very minimal per month, and your capitalization rate is low, your cash on cash return is low, and your total ROI is low. All right? So, did I rest my case? Phase two, right now, the best area to buy in the country is in Central Florida, Orlando Metro, and Tampa, Florida Metro. And of course, Gene Gillum, my Florida partner, has been selling a lot of these great investment homes to my investment group. All right? So, any of these other areas, even though it is in phase two recovering cycle, is typically not conducive to a turnkey real estate investor, as far as I'm concerned, right? They were a little bit beyond your capability. They were not meeting the 1%, except in Central Florida. All right? So, if you have any questions, feel free to contact me. So, excellent time. Phase two is a very good situation, right? Low construction, demand for homes exceeds supply, still very affordable for homeowners and investors. The prices are rising. I kid you not, in this phase two cycle expansion. All right. So phase three, okay, which is the exuberant phase. Now this is getting a little bit risky, but again, it all depends in what specific market. Phase three, exuberance, and which is capital flowing freely, surging prices and volumes, affordability getting worse, or construction getting high, and smart money taking some chips off the table. So you really have to be very careful if you invest in the phase three area. And phase three, look at the cities in phase three. Phase three: Orange County, Southern California; Dallas, Texas; Seattle, Washington; Austin, Texas; and the Bay Area, which most of my members of the Year Real Estate Network are located in the San Francisco, Northern California, Bay Area. So before I will go over what are my thoughts around the Bay Area, let's go through some of these other markets. Seattle, right, is a high-tech boom as well, but the prices are very high. The average medium price in the Seattle metro is probably $400,000-$500,000. So as an investor, are you going to buy single-family home rentals or duplexes in Seattle? I don't think so, because look at the 1%. $500,000 multiplied by 1% rent to price ratio. You need $5,000 monthly rent in order to achieve good positive cash flow on a median price for homes in Seattle. So as an investor, I would cross that out. Dallas, same thing. Orange County, too expensive. The median price of homes in Dallas is already like $250,000, $275,000. Okay, the typical single family home, 1,400 square foot, whatever, a single family home pricing. If it's 275,000 in Dallas, multiplied by 1%, you need a gross monthly rent of $2,750. Are you gonna get that? No. Okay, I rest my case. A little bit too late. Orange County, Southern California, depending where it is also very expensive. Median price of home is probably 500,000, 600,000, right? Multiply by 1%, are you going to get $6,000 monthly gross rent? No. So as a risk investors in these markets, I wouldn't go there. Austin, Texas, yes, not inside Austin, but the suburbs of Austin, still some affordability for investors, right? Like Hutto, to the west, to the east of Austin, 20 miles to the east of Austin, there are still some single-family homes for like 200K. It rents for 1,600, so you still can get some decent cash flow, 6% cap rate, right? In the south of Austin, like 20 miles below south of Austin, it's booming, right? The corridor right above San Antonio, like New Braunfels or what's the other town? Okay, and those homes like 180K, you get about $1,500 gross rent. So still pretty decent opportunity left in Austin, Texas. All right, you follow me? A little bit less than 1% ratio. That's fine. So pull the trigger there if you can. And finally, on phase three, exuberance, we have the Bay Area. you know my thoughts and my sentiments. Is way an average home in the Bay Area, San Francisco area, in the East Bay and South Bay, in the Silicon Valley is outrageous. The affordability factor is just off the chart. The median price for homes is around $1 million. As a real estate investor, you can buy a home for $1 million and rent it out for $10,000, which is 1% rule. No, it's too expensive. In fact, many of my members, they are engineers. They make like $150,000 a year. They just moved in the Bay Area recently. They are still renting. And right now, the Bay Area prices is at a peak, right? I know it's fueled by high tech. Don't get me wrong. There's a lot of jobs in the Bay Area. A lot of people are still moving in the area because of high tech boom. But if there are any minor hiccups in the high tech sector, some of these homes will be crashing down. Some of the home housing prices, right? Is it's extremely expensive. One of the most expensive areas in the country is at phase 3 is at a peak price. Had you bought 20 years ago in the Bay Area like I did in Fremont, you made out like a bandit. Have you bought a house in the Bay Area 10 years ago or even 5 years ago? Depending on what area of the Bay Area, you will probably your housing equity have increased maybe 50 to 75%, even 100%. But if you want to buy a home to live as a principal home area, it's way too expensive. It's just outrageous, right? I know some people are still gonna do it. That's fine. The quality of life, weather, recreation, whatever. But I don't know. Personally, if I were new to Bay Area, if I make tons of money, six-figure income, I wouldn't buy a home to live in. Certainly not a rental property, right? So I rest my case. That's why I take my investors out of state to buy in other areas, Texas and Florida. All right, you follow me? So phase 3 exuberance you have to be very cautious because it's getting risky out there. And I'm not going to talk about phase 4 and phase 5 too much because we may never see this two cycle ever again. Phase 4, as you can see, a little bit of downturn, is contraction. It's early downturn, very scary, right? You need to lock in the purchase price at today's great interest rates, right? When you lock in the purchase price, the price would, and the lock-in interest rate, you are set. Okay, and the interest rate might go up after the election. So timing wise, buy in phase 2. Okay, anyway, phase 4, I'll be real quick. Phase 4 is capital still being deployed. Some people are still investing in phase 4 markets. Smart money in full de-risking mode. Okay, contraction early downturn is not a good sign. All right, you're buying it too late in a cycle. Your timing is all wrong. Now, the only previous real life example on phase 4 is like back in 2003 and 2004, right? When many investors didn't do their research, didn't look at the cash flow scenario, didn't look at the numbers, and they purchased at a peak in phase 4 back in 2002, 2003, many markets. And then in phase 5, right, capital losses, full downturn recession. Look, I don't have a crystal ball, and not no one can claim they have a crystal ball. I don't think we ever gonna reach phase 5. Phase 5, if you have a on recent history, is really back in 2007, 2008 when the market crash and the recession occurred in 2009, right? So we don't want to go there. So okay, to recap, the best time to buy in phase 1, which is 6, 7, 8 years ago, that's over. Phase 2 right now, 2016, still some opportunity. I like Florida the best, as many of you know, right? So it's all about timing. Pull the trigger, lock in the rate, lock in your purchase price, and get the cash flow, and just go through a long-term journey of creating your real estate portfolio to achieve your financial freedom. Okay, phase 1, phase 2, phase 3, 4, 5, and so that's pretty much I have to say. So hopefully these help. And of course, if you want to time the market, and if you want myself and my network to help you to create a real estate portfolio of turnkey properties, cash flow, great property management, you contact me, Si-Wing Yi, at 510-552-0726, and you can text me as well. And of course, my email is siwingyi at siwingyiseminars.com. Thank you so much for listening. Hopefully this helps, and looking forward to working with each and every one of you to help you achieve your goals through turnkey out-of-state real estate. Thank you so much, and have a nice day.